In the book, I showed an example of using gross output by industry. This is publicly available data from the U.S. Bureau of Economic Analysis, and we use it to create a proxy for machinery manufacturing in the United States. When you combine something like this with a set of market multiples, you can create a very convenient and powerful benchmark of return expectations for deals that occur in that space. I call it a market return matrix and show you exactly how to set it up in chapter 12 of the book. This one is based on the machinery manufacturing numbers that we showed in the last shot and some middle market private equity multiples from a popular data provider. What this does is tell us how much of a deal's gross multiple of invested capital is driven by broader market forces based on various entry and exit dates. Let's consider a deal acquired in 2010 and then exited in 2014. Here at the intersection, we have a market-driven equity return multiplier of 1.81x. This is the number that any deal in the space must beat for the GP to claim any kind of financial, operational, or manager-driven equity value creation. If the deal is at 1.8x or lower, the entire return can be explained by the 28% increase in the addressable market and the 3 turns of multiple expansion that followed the Great Financial Crisis. Exactly how much of the equity return can be explained by these market movements can be measured with this relative value creation formula that we described in VC 106. For example, if a deal has a gross return of 2x, you can take log 1.81 over log 2 to get 85.2%. This means that 85% of the return was driven by the market and only 15% was driven by the manager. However, if the deal has a 3x return, you can take log 0.181 over log 3 to get 53.8%. This means that about half of the equity return is driven by the market while the other half is driven by the manager. Now, let's look at a deal that was acquired in 2012 and sold in 2016. Here at the intersection, we have a market-driven equity return multiplier of 0.84x. This says that a typical deal in the space would have lost money because the addressable market shrank by 13% and the market multiple contracted from 874 to 846x. In this case, even a GP that loses money might be credited with creating positive value as long as the return is better than 0.84x. We can see this play out in the relative value creation formula below. For a 2x deal, we get a market-driven return of minus 25%. And this means that 125% of the equity return came from financial, operational, or manager-driven initiatives. In fact, we might want to reframe the deal's return multiple to reflect this. Considering the GP generated a 2x return in a 0.84x environment, we can use this formula to show that the manager-driven return multiple is closer to 2.4x. So that's a quick overview of the market return matrix and how an LP in particular might use it. They are quite easy to build, and the next time you're sitting through a GP's annual meeting, you can use something like this to check those narratives and figure out exactly how much of each deal's return was driven by broader market forces.